Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and or financial topics. So we're going to dive right in, take a look, and see what people are sharing. If you want to follow me at _finance, and if you want to join our community where I go over a whole bunch of different investment opportunities, check out finding-value.com. I've got a special going on. Specials, the coupon code if you'd like to try it out. Description link for those specials. So Silver Chart says strong breakout of Dow versus gold, even though it's gold versus Dow in his chart. Gold's been outperforming general equities since 2018. But that trend has accelerated rapidly in recent months. A 1-to-1 ratio has happened before, and with the greatest global debt binge in all of history unraveling before our eyes, a repeat performance is likely. Even a return to a 2-to-1 ratio would result in major outperformance by gold. And what he's got here is a breakout to the upside of gold outperforming the Dow. Now, I want to show you a chart. We were on the Discord on the website. A couple of us were throwing some charts up. And this is XAU USD versus the S&P 500. And if you can, I just threw this across here. Now, maybe this was just an overextension for gold against the S&P 500. They threw it out. But this is a three-hump consolidation. And it's been squeezing into the corner here. And what if we break out and go all the way back up like this? Maybe we even come back to here. That is massive outperformance if that were to occur. Now, here's something that's a little bit interesting, and I was just charting some things. Check this out. So this is U.S. oil divided by XAU USD, or no, SPX. U.S. oil versus SPX. Look at this thing. This is crazy. It's a falling wedge. We're coming into the corner of this falling wedge. And again, this is U.S. oil versus the S&P 500. In this circle are fractals that led into the big move. We've got the same fractal leading in to these big moves that we've done before. Basically, this is an inverted shoulder, head, shoulder, shoulder, head, shoulder. And we're at the right-hand side of this shoulder, much like 1972. And if this does occur, the breakout is generally the size of how big the opening is on the end. So if I were to grab this, that's the size of the opening there. And that is what would be projected on the breakout, going back to the top of 0.45. That's oil outperforming the SPX. That is insane, because the equities of oil would do something like 3 times or 4 times that. And this blows my mind that this type of setup is here, and it also aligns very well with other types of setups in the markets here. Just absolutely mind-blowing. And as gold, which is the leader, starts to break out against these major indexes, that means we're starting the move. This is the beginning stages of the beginning of the move. And then we're going to see probably crazy things occur during this next commodity bull market that even I'm going to be probably astonished with. I've done my best to search for the companies in the world that can still grow production in oil of the stuff that I think is going to go scarce. And we are going to benefit from this big move of oil outperforming the S&P 500. Keep in mind, oil is also incredibly cheap against gold right now. It's like a 45-to-1 ratio, 45 barrels to 1 ounce of gold. Gold leads, so it moves first, and then oil is going to revalue itself when the markets stop going down quickly, is what I'll say. It's going to be insane. Who's ready for $50 silver? Buckle up. Well, I'm ready, buddy. Silver's looking fantastic. Silver looks fantastic, and silver goes up when these conditions start to occur. Another thing, when silver goes up, interest rates. When they go up, silver generally goes up. It's about to become 9 weeks in a row, which is unreal. So he's talking about oil. Oil is down for 9 weeks in a row. There are a few instances of 7 weeks in a row, but the last time it surpassed more than 8 weeks in a row was back in 2015, which was 10 weeks. So it feels extra painful this week. You are breaking one for the record books. And here's oil right at support. Now, some people think that this is going to break lower. Some people think that it's going to go up. What do I think? I think it highly depends on the market conditions. If we do get a recession, then yes, it's going to be pressure to the downside on oil. All of the metrics that you look at from a ratio perspective and from an inventory perspective are bullish for oil to go up. So commercial inventory, where we're located for inventory levels, would indicate a oil price in the mid to upper 80s. That is fair value. Expensive would be $100 oil right now. Would be a little bit on the expensive side. Right now, we are 2 standard deviations on the low side from fair value compared to history given inventory levels. Now, that is poor market sentiment. Now, some people think, oh, we're going to have this, move lower. Then I would question, if you think that, then explain to me why copper is going up and why silver is going up. So if I were to put U.S. oil and I were to overlay, here, let's do crude oil, this one. There's a lot less crap on this. And let's overlay copper and silver. They basically move together. Yes, they can diverge a little bit in some of these areas, but for the most part, these guys move together. This is the last bull market. I can square it up in the last bull market. Oil outperformed silver, and it also outperformed copper. It is a more leveraged play than both of those. But the overall trend is that they move together and they pull back together. Well, why is there a discrepancy between copper and silver moving up and oil moving down? That's the big question. And will the alligator jaws close with oil moving monumentally higher to catch up? I don't know. We'll find out. I think that oil is underpriced and people are misreading the market conditions. I could be wrong, though. So I'll eat it if I am wrong, and I'll wait for those market conditions to come for oil as copper breaks to the upside and silver does. Realized global oil inventory dropped 1.31 million barrels per day. The IEA added 2.33 million barrels per day of fake balance to justify their stupid forecast. Are they playing with the numbers to try to manipulate oil lower? My answer is yes. Undoubtedly, yes. There are instances of the Biden administration paying money to news sources to create false news. Think about that for a while. I'll take the opposite bet. It says, will we end with zero inventories and $50 oil? This market is a total crap show. Tavi says, silver miners are on the move. Major breakout in the making, in my view. Downtrend line break for the silver miners. This is SIL ETF, monthly candlesticks. Yes, we're going to see the miners start to rip here. Now, what you want to do, in my opinion, is sit down and look at your portfolio and say, hey, do I have enough allocation to this sector or another sector? And no, I am not going all in on any one sector. That is how you can make or break a portfolio. Yes, concentration works really well if you're right. It also can destroy you very quickly. Even more so if you put leverage and concentration on it. That's where people go broke. So what I do is I construct a portfolio of undervalued assets across the board, and the asymmetry carries the portfolio higher if some sectors outperform other sectors. So I don't have to win on everything. If I lose on half the portfolio, let's say it goes down 30%, but my winners go up 5, 6, 7, 8, 9 times, I win. Now, if another market condition comes and I read it, let's say incorrectly, then the other portion of the portfolio would go down 30, 40, 50%, and then the other portion could go up 5, 6, 7, 8, 9 times. Asymmetry carries the whole portfolio higher, and then you spread it out against ones that might work in different market conditions, like silver and gold versus oil. Now, when you concentrate in just gold and silver and just oil, that's when you can get problems in the portfolio. Coming on back to my profile. There we go. So coming on down, we've got, you can run JP Morgan, but you can't hide. The previous iteration of the JPM balance versus real inventory chart was discontinued due to the backlash. Well, here's another version of the JPM. I don't know why they keep doing this. They're trying to show the markets with data that they think it's going to go up. Here's the problem. The reported one keeps going down. They revised this, just to let you guys know. They had this going way up, and they were all wrong, so they revised it lower and then changed it. We were warned, buyer beware. This is the number one in overvaluation across the board. Combined trailing PE, forward PE, CAPE ratio, price to book, enterprise value to EBITDA, the Q ratio. I think that's not the current ratio. I don't know what the Q ratio is. Market cap to GDP. We are higher than all the other previous bubbles in history. Do you know every single time in history here that these were the beginnings of commodity bull markets? Every single one. Here we go. We're getting to the beginning of this bad boy. It's going to be fun. Current oil to gold ratio 45 to 1. In 2000, oil to gold ratio was 9 to 1. Think about that for a second. So let's say gold continues to go higher. Let's say we get $4,000 gold out in the future. Divided by 9, $444 a barrel oil. Gold moves first. Oil does a catch-up move behind it, generally speaking. There's $500 oil out in the future. Is possible depending on where gold goes and depending on how much the ratio squeezes. 45 to 1 is the second cheapest time in history, going back to the 1800s that oil's been this cheap to gold. You think something's going on with it? Some people say, oh, well, the gold's going to continue to get more expensive. Okay, I'm sure it won't. Not if you take a longer time horizon. Gold is going to revalue all the commodities higher. Think about that for a second. Now, there could be short periods of time where people rush into gold and silver, platinum and palladium to save purchasing power against an erosion of purchasing power. That is what's coming. And it has started. Smart money's buying gold right now. Smart money's starting to buy silver, and platinum is going to do last. If you look at the Weimar hyperinflation, platinum was priced 5.5 times more expensive than gold. Platinum's about to break out. I don't know where these things are going. I'm not saying that that's going to occur again, but it's a possibility because it's occurred in history before. Ian McMillan says, we are now essentially at the level where we saw the initial relief bounces and consolidation areas in late 2018 and 2022. So what he's doing is he's taking the retracements of about 23% retracement, and those are the dark black lines. And this is generally where we could see a consolidation pause here, which has happened before. It happened in 2022, 2018, and maybe we get a consolidation pause here today in the S&P 500. SILJ and silver, will we see a 1-to-1 ratio? The junior silver miners is at an extreme undervaluation relative to the metal itself. The only other time in history that SILJ was this oversold relative to silver was in 2016, which preceded a big run in both. However, during that 6-month run, SILJ outperformed silver by approximately 4x. Will history repeat? I'm not predicting such a rapid move, but history suggests that it is certainly possible. If silver were to reach $50, a 1-to-1 ratio would put SILJ at $50, a 4x move from current levels. Speculating in silver miners has been an incredibly frustrating and volatile endeavor, but I expect that patience will be rewarded in the fullness of time. Here's the ratio at very low levels, and maybe we get another surge higher in SILJ. If silver starts to run, money rotates and runs at it. And silver juniors are tiny little company, tiny little market cap in relationship to everything else. Of course, I hit the wrong button. Coming back, we've got, if this happens today, how many times do you think they will halt trading in the coming years? And this is the 1929 depression. It has the same fractal. And yes, we could go down like this, but I don't think it's going to be driven by the same drivers. Here is my take. 1929 was driven by a deleveraging event in real estate. We had a bunch of bad loans in real estate in the 1920s. Those bad loans came back to the banking system. The banking system barfed them all up because they couldn't absorb that amount of loss. 1929 is not going to be like what we have today. In my opinion, the S&P 500 is going to drop because of resource constraints. Resource constraints and problems with inflation in the system is going to be the problem. And the S&P 500 at the current price to earnings ratios and the valuations that they currently have, like we saw up here, they're completely mispriced for the resource constraints that I think are coming. So we're going to come way back down, and I don't know what will fix the resource constraints necessarily. There's no easy resource fixed constraint out in the world. Now, we grew into this entire world. Oil is going to be a main driver of this. Oil. And that was this chart that I showed you guys against the S&P 500 squeezing into the corner here. U.S. oil versus the S&P 500, and I think this thing is going to absolutely moonshot. That is the resource constraint that I think is going to be the problem. It says, love this chart, marries up with my take on the NASDAQ. What would cause such a widespread panic in crypto? This is a big move lower. This is the NASDAQ 100, what he's projecting. Very similar move to here. This is oil versus the S&P 500. It's a double bottom. If you squeeze into the right-hand side, you can see that we've squeezing up, broke upward, came back. We have a higher low, and this could be the beginning of a move higher for crude oil versus the S&P 500. The S&P 500 has been falling. Crude oil has been basically trading sideways. This could trade sideways for a little bit as the S&P 500 falls. And then when we regain composure in the S&P, like maybe consolidate sideways, crude oil could run big. Inflationary recession, I don't know. We'll see. Silver versus the SPX2, you can see it's a big double bottom, just like oil is. And then we've got a breakout of silver today against the SPX, just creeping out a little bit above that downtrend line. It's the first stage of what could be a pretty big outperformance. Nostra says they're going to crash the stock market to try to stop gold. The bankers are scared. Well, if the stock market drops, generally money rotates into gold. So I don't think you can stop gold by crashing the stock market necessarily. It's pretty easy to get well-to-do slowly, but it's not easy to get rich quick, says Warren Buffett. The desire to get rich fast is pretty dangerous, says Charlie Munger. What happens is people take on too much risk, they take on leverage, and then they generally go belly up. They go bust. To do it over a longer period of time, what you do is you buy undervalued assets, but you have to be patient for that to work out. It doesn't happen overnight. Overnight is gambling, basically. So a lot of people, if you look at the shorter time frames, the day traders, they go broke with basically almost 100% certainty. No one does well day trading. Like it's almost 100%. 99.99999, like you're basically lucky if you can do it. And then if you start swing trading and doing shorter ones, they all go broke too. So basically, everyone goes broke that tries to make money very quickly, because what they do is they take overly large positions, generally with leverage. They try to do options, and almost all of them go broke. Smart Real Estate Bet says, but new home sales are dying. No, kidding aside, this is good news. So 14.5%, the percentage of total U.S. home sales in 2024 that were new construction. You can see that new construction is coming up for that. It's because we don't have any existing home inventory. So they're really leaning on new home sales, being a large portion of the sales out there. Aluminum futures looking like a ticking time bomb ready to just rip to the upside. I agree with that. Does look pretty good. Freight futures, dry bulk flat for Capesize, Panamax up 2%. Tankers, VLCC was flat, and Suezmax was up 1%. HFI Research, natural gas injection storage math. Where is storage by November of 2025? That's what he thinks it might be, which will be on the low side. So as we come on down on the lower end of the storage, he thinks that we're going to only build to the lower end of the normal builds. As demand continues to go up, our days of coverage are shrinking and shrinking. This is going to inject tons of volatility into natural gas pricing. We have a ton of demand coming from LNG exports, guys. This is going to be crazy. I don't know how this transition is going to necessarily work here. This could be pretty ugly. Grady says, yes, the next monetary system will come from the East. Yes, COMEX will run out and default. Yes, precious metals manipulation will end, most probably already has. Yes, the United States dollar will lose reserve status. Yes, the U.S. debt ceiling will be raised endlessly. Yes, the debt cycle will end in chaos. Yes, a larger war is coming pushed by the West. And yes, we need to prepare in detail for what is coming. So no, as I see it, I do not spend your precious time on posts, articles, interviews that only exploits and repeats the given. Consuming the same info over and over again does not add value, especially not when the larger trend is still on track and when the outcome is given. Focus on preparing, action, and price instead. Knowledge, experience, tools, and mindset will be key to get through what is coming, as will ignoring bias, emotions, opinions, and narratives. Also, macro nowadays has way too many parameters for anyone to get direction right consistently based on that alone. That leaves us with the charts, which I generally think is the only real edge we have left in these markets. Smart Real Estate Bet says, you could add every year since 1972 to the list below except 07, 08, 09, and 2011. Recency bias, it's a thing. It says you're stupid if you buy a house now at the top of the market. And this is regular people saying you're stupid in 15, 16, 17, 18, 19, 20, 21, 22, 23, 24. Glad I didn't listen to them. Everyone's calling for a crash. Regular people, people on YouTube, people on Twitter. Look at this data. The housing market's so bad. Guys, it goes up almost every year. And there's only a handful of years since 1972. There's 1, 2, 3, 4 years it went down in all since 1972. But it's a bad time to buy a house. Sure. So GDXJ is now most probably breaking out above the purple line. The really big move starts above the black line. Remember that profit is made when you buy. Most will miss the bull market as usual. For heaven's sake, take notice now. Get proper guidance. This is GDXJ gold miners. They're breaking out of the purple line here. We have the black one, which is the last line of defense for resistance, and then it's off to the races. It says a massive rounded bottom arc cup in the making. Now climbing up the right side, expecting a reverse symmetry move back up to all-time highs. David Burrows says, this is getting very interesting. Silver is breaking out and can get very stretched above the long-term moving averages in a bull market. This is likely just the beginning. Here we go. Silver's about to really move here. Here's Grady again. The global capital rotation into commodities is not starting now, nor is it confirmed now. It started years ago when these ratio charts below turned, which I posted on in real time back then for each chart. The capital rotation turn is not now. It happened years ago, says Grady. And this is the CRB index versus Dow Jones. The bottom was 2020. That's the beginning of the super cycle, like I said. At least someone agrees with me. That's good. We've got Dow Jones versus gold. The top there was 24, and it's pulled on back. 2018 was the big PM move from there. We've got gold versus the SPX, gold versus the stock market. That bottomed in 2022. Now we have a confirmation of breakout on move above the red line there. Big 14-year bullish falling wedge. And then we've got the Huey, which is the gold bugs index versus the semiconductor. That bottomed in 2024, and we're breaking out right now for the untouched black arrow at the very lows. Falling wedge, and we're breaking out of everything. So what do we do here? What's the plan? It's to get commodities, the equities, and just sit and wait. Don't do anything. Don't touch it. Don't look at it. Just let it go. If you want to add to it, then yeah, there's a bunch of really good entry points across the board here. And they're going to be in areas that everyone's telling you don't buy it. Yeah, don't buy oil. Don't buy energy service. Don't buy this. So it's been posting this chart for years now saying platinum will break out when it is ready. The fact that this chart gets few likes still is a good thing, as it shows people can still not believe it. And at the same time, the 100 posts on e.g. COMEX defaulting gets people excited and active. It is like most people have forgotten that it is value one should be looking for and not waste time on attention-seeking posts, especially for things that are given to happen but years from it. This is probably, though, because most look for instant gratification and are drawn to posts that offer the promise of metals going to the moon as of yesterday. Most have no patience and not enough knowledge to sort out what is true value and what isn't. Platinum is now seriously thinking about going for the mega breakout. Russia, China, and Iran are now stacking silver and platinum. Russia is looking at banning exports of palladium and platinum. Just like silver was, platinum is sitting right below a historical, huge blue breakout line. It has been in a cyclical bear market for 17 years, and it's about to break out and resume its secular bull market. A generational breakout and opportunity is incoming also for platinum. Platinum has now been basing out for about 10 years, just like back before the start of the secular bull market in the 1990s. The coming blue breakout will confirm the resumption of the secular bull market for also platinum. And the coming blue breakout will also confirm that wave 3 has started, which is the strongest and most profitable phase. Platinum has a very, very long way to go. The posted ratio charts look fantastic. What the exact final target price will be is not important right now, really. What the important is to get ready and get real guidance along the way, even before, so I'll skip all that. But platinum quarterly chart, 45-year, it's ready to break at any second here, guys. Huge flag pattern, 1, 2, 3 hump consolidation, 1, 2, and we're ready to rip on the third. So this thing's ready to go. It is ready to go. I am loaded to the gills in this thing. I'm excited. I bought the bottom here in 2020, so I've been buying at specific levels, and I'm ready for this to basically push me over the edge. This will be, I think, this single position here will probably, I mean, I could probably do whatever I want just off platinum here. Platinum and silver. Those are my two that I really, really like. Over the past decade, total non-OPEC oil. Okay, we went over that one last time. So we're going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. There are some ways to play platinum and the platinum group metal companies and mining companies. I look at the silver mining companies, silver juniors. I took positions. I didn't take positions here recently. That was back, I probably took them about a year or two ago, in some of them at the bottom of the bottom. They're putting in big double bottoms. I was just picking them all off, and now I'm up hundreds of percents in some of them. And now I think they're going to go up way up. So what am I going to do? Nothing. Just let them go. And whatever's still down, I've been buying here recently, and that's what I go over in my midweek updates and the Q&A sessions are those opportunities. But that's what I've got for today, guys. We'll catch you next time. This is Finding Value.